There is so much to talk about. A lot of negative news floating around out there. Of course, the debt ceiling, what the Fed is going to do, economics. But I'd like to start with some positive news, if you don't mind. First of all, please enjoy a safe and happy Memorial Day weekend. But as importantly for the financial services industry, we had earnings season, and we ended with an absolute blowout of a report by Nvidia, one of the best reports we have seen in a long time.
Right. Well, before I joined you, David, Annex, I was a semiconductor analyst. I managed a tech fund and a mutual fund. And frankly, I have never seen a report like that, where basically analysts were thinking they would do $7.2 billion in sales in the quarter, and they actually came in at $11 billion. This, again, reinforces the importance of artificial intelligence, not just on how it affects semiconductor companies, but how it affects the future profitability of every company.
And you think about what the stock did, of course, up something like 20% this week alone. If you did have that position, it's certainly worth taking a look at because, of course, trees don't grow to the sky. But, you talk about AI, for example, and what that can do. And there's so many companies that are part of this now. And you think about some of the strategies that companies will employ, it could change their earnings outlook.
No, I actually think it saved the market. In fact, Nvidia, despite the 20% advance you just mentioned, is actually cheaper now than it was when it reported because the estimates have gone up 75%.
Yes, right. So let's talk about, for example, earnings and valuations because, there really is this dichotomy of those that have and those that do not have in their earnings world. So we often talk about the top number of stocks that really have driven the valuation, but I think people have to look under the hood.
Well, that's right. And when you think about it, those top 10 names are all very well-positioned companies. They earn great free cash flow. Some of them pay dividends. They're good companies. And frankly, what I hear on the TV all the time is people bemoaning the fact they don't own those stocks because, again, it's what you own, not what you don't own that matters. But when you think about the larger S&P, the other 490 names, they're trading at about 15 times earnings. So that's not an absurd valuation. So my expectation is this rally will broaden over time.
And so let's think about some of the risks that are out there. You cannot get away from the conversation about the debt ceiling coming together or not coming together, and it certainly looks like there's a framework in place. But this X date, the date that, of course, that the Treasury runs out of money, probably could be June 1st, give or take a couple of days, and there is a lot of things that are going in there, but the debt ceiling is very likely to be lifted through 2024 with spending caps. And I think that's an interesting idea. It's just not raise the amount of money, but cap it out. And I think that's a digestible idea.
And we've often talked about this, the political shenanigans that go on in Washington, because essentially nobody has an incentive to cut spending because spending gets you votes, both sides. But what we're trying to do finally is see some rationalization there, which is one of the reasons why we've seen the dollar weaken and the rest, because people at some level are starting to lose faith in our politicians. And fortunately, this deal pushes us towards a better circumstance.
And so you think about some of the things that are in there, and I thought there was some really creative ideas in there. Of course, a big part of the spending was this $80 billion that was allocated to the IRS through the Inflation Reduction Act, and of course, air quotes for radio right now. But you talk about some ideas of redirecting some of that $80 billion that both sides at least were talking about. For example, you reduce the amount of money that goes to the IRS, but you increase some of the democratic ideas, like, for example, the National Institute of Health. So I thought that was a creative idea that could come out. But of course, that is really what is driving a lot of the consternation and the Treasury market. And I do want you to talk about what has happened with Treasury yields as of late.
Well, Treasury yields have started to rise recently, partly because inflation is persistent, but also because obviously when they pass the debt ceiling deal, there's going to have to issue a lot of treasuries to basically replenish the Treasury's coffers as well as fund the government. As we've mentioned any number of times, 1/3 of U.S. Treasury debt is going to mature in the next 3 years. You would think that would put upward pressure on interest rates.
But there's a lot of stuff happening that we do want to talk about, and maybe it's not the equities, but the fact that cash is not trash anymore.
No, it really isn't. If you think about the long-term expectations for stock market returns, you get about a 9% number, which is roughly 5% ahead of inflation, and that's been true for years. But right now, you can get about 5% in a T-bill with a 3 or 6 month duration. So you get more than half the return with no risk. So what I would say is a little uncomfortable with the headlines, perhaps worried about China invading Taiwan or whatever else it is, you can take a little bit of money off your equity exposure and buy a T-bill and wait it out.
And let's talk about how we got there in the first place. Of course, we all know the backstory that inflation got out of control, and the Federal Reserve had to raise interest rates to purposely slow down the economy, especially the housing market, which is the most volatile part of that calculation. And they have done that. There's no question they've slowed that down. Mortgage rates ticked up over 7% for a nanosecond. But as importantly, short-term interest rates went up. Now, the Federal Reserve did this because they had to slow things down. But there are winners and there are losers in this space, Derek. And now the Federal Reserve has to make a choice of what they're going to do going forward. And if you believe some of the prognosticators, they think interest rates are actually going to come down at the second half of the year.
Well, that was the expectation. That's changed fairly dramatically in the last week or so. Now there's a 60% probability the Fed might hike by 25 basis points in June. But again, that's data dependent. And we know that the comps on inflation for the next couple of months are relatively easy. And by that, I mean last year inflation was running really hot. So this year it's going to look a little better, but then it's going to reaccelerate in the summer months, in August in particular. And oil prices, too, they're a wild card. Gasoline prices are down 23% year on year. OPEC meets on June 4th. The Saudis need $80 oil, and our strategic petroleum reserve has been dwindled down. My bet is oil prices will move higher throughout the balance of the year. That will, again, make the Fed's job more complicated, but such is life.
Well, and it's a big deal. You know, the old saying of you can't fight the Fed still exists. But, you know, these interest rates that were at zero, a lot of folks have said maybe that is, you know, something that we won't see again. But if you do believe that the Fed overshot, in other words, they raised interest rates so fast and so aggressively that they're really going to slow things down in the end of this year and in beginning of 2024. They may be in a predicament where they're going to have to change interest rates and get back down. That is something that we're going to watch.
But what people keep forgetting, the Fed is not just raising rates, they're also doing QT, quantitative tightening. They're removing liquidity from the system. And as I mentioned earlier, a debt ceiling deal will also do the same thing. That's why in terms of the equity markets, you have to have a balanced approach. Yes, if we rally 5%, I think you'll lighten up a little bit. If we go down 5%, then you have dry powder to buy it. I mean, it's portfolio management, simple. It's risk management as well.
And you talk about risk management, of course, folks, and you think about one of the things that you can do, and one of them, of course, is not overweighting. You know, the thing that I was talking about during the break is an overweighted position in a particular stock. Well, that is not a risk management tool that we would encourage people to do, but that happens in portfolios. You need to go through your portfolio and make sure you know what you own, why you own it, and how much you're paid for it. And every single day, we have people come in and show us their statements, and we make suggestions about what they should do with their portfolio. That is one of the possibilities that you could look at when you come in and work with Annex Wealth Management. But Derek, there are other defensive positions and postures that people can take.
Right. Well, I don't believe in diversification. In other words, people think that the more stocks they own, the more diversified they are.
Diversification. That's
diversification.
funny.
Well, Peter Lynch coined that phrase a long time ago in One Up on Wall Street. And they're just simple truths. You're buying businesses. You're not buying stocks. And if it's a good business, you let it run, because over time, they'll generate cash flows. They'll grow their earnings. They'll hire more people. They'll destroy their competitors. And that's a good thing to be in. So you don't want to buy garbage. You don't want to buy stocks just because they're cheap. You want to buy stocks that have a catalyst, a good management team, and frankly, a company where the insiders own a lot of shares.
And you look at a lot of this information, folks, and we go through every one of our holdings. We've got a great team in our investment portfolio team, and they really go through every one of these. They listen to the earnings calls. They do the work. So if you're interested in employing us, you can go to annexwealth.com and hit the Get Started button.